Hey guys, what's up? I'm Erin and welcome back to the channel. If you're planning on retiring early prior to the age of 59 and a half, one of the biggest questions you might have is, how do I access my money? Because if you pull from the wrong account too soon, boom, 10% penalty, unexpected taxes, and suddenly a lot of regret. But if you pull from the right accounts with the right strategy, you can avoid penalties altogether and keep your tax burden low. So let's walk through the 5 most powerful strategies early retirees can use to access their money before retirement age, including how to avoid penalties, reduce taxes, and build a smart, flexible plan that supports financial freedom. Number 1 is a taxable brokerage account, your early retirement bridge. This is really the cornerstone of most FIRE strategies, financial independence, retire early, because a taxable brokerage account gives you what traditional retirement accounts can't. Complete access to your money at any time, at any age, for any reason, no early withdrawal penalties. You can take advantage of long-term capital gains treatment, which is taxed at a much lower rate than regular income. The ability to do tax loss harvesting to lower your overall tax bill, and 100% full control over when and exactly how much income you take so you can manage the tax bracket you fall in from year to year. And here's the best part. If you're investing in low turnover index funds, something like a total stock market fund or an S&P 500 tracking ETF, your tax burden is usually going to be quite low because these funds rarely trigger taxable events unless you sell, which puts you more in the driver's seat of your tax situation. That's why most FIRE investors aim to build up 10 to 15 years worth of expenses in their taxable brokerage account. That buffer gives them money that they can access if they want to retire in their 40s or in their 50s and allows them to leave their retirement accounts untouched until later. This fund really gives you freedom, flexibility, access, and choice on how you want to live your early retirement. Let's look at the real-world tax burden of a couple popular funds. We have VTSAX. The annual yield is about 1.8%, with the majority being qualified dividends. Capital gains distributions, virtually zero. Vanguard's patented fund structure has allowed it to avoid paying out net capital gains in most years. The overall tax drag, typically around 0.5% to 0.7% annually, mostly from dividend taxes. Then we have VOO, the Vanguard S&P 500 ETF. The annual yield is about 1.3%, again, mostly qualified dividends. Capital gains drag, effectively zero, thanks to its ETF structure using in-kind redemptions. Overall tax drag, around 0.4 to 0.6% annually, almost entirely from dividend taxes. Now, even though most of these dividends are qualified, that doesn't automatically mean you pay zero tax. Qualified dividends are taxed using capital gains brackets, but it's still based on your total taxable income. Your ordinary income fills up the buckets first, and then your capital gains are sort of stacked on top of that and taxed at whatever rate they tend to spill over into. Here's how the 2025 tax brackets break down for long-term capital gains and qualified dividends. We have a 0% bracket, a 15% bracket, and a 20% bracket, and the amounts do vary based on filing status. Also, if your modified adjusted gross income exceeds $200,000 as a single filer or $250,000 as a joint filer, you may owe an extra 3.8% net investment income tax on top of that. So how does that actually hit your wallet? When your income pushes you past the 0% bracket, your dividends begin to be taxed at a 15% rate or higher if you happen to be in an incredibly high income tax state or if net investment income taxes apply. Even with modest yields, that creates a quiet drag on your portfolio, often in the 0.4% to 0.7% range per year. It's not devastating, but over time, it does add up in these taxable accounts. Let's say you're married, filing jointly and earning $90,000 in ordinary income. You also get $10,000 in qualified dividends, bringing your total taxable income to $100,000. In 2025, the 0% tax rate on qualified dividends applies to up to $96,700. Since you're just over that threshold, only $3,300 of your dividends get taxed at 15%. The rest still qualifies for the 0% rate. So your blended tax rate is closer to 5%. Still a drag, but not nearly as harsh as it sounds. For context, with something like VOO, which yields about 1.3%, that kind of tax rate would cost you just 0.07% of your portfolio per year. And yes, that number can creep higher if you live in a high-tax state or owe net investment income tax. Now let's talk real numbers and why tax planning matters so much over time. Let's say you invest $7,000 per year for the next 35 years and you're able to capture an 8% rate of return. With a Roth IRA, you can contribute after-tax dollars. The money then grows completely tax-free, and any withdrawals you take in retirement come out without you paying a dime in taxes. After 35 years at 8%, your account would grow to over $1.2 million, and you get to keep every single penny. Now, let's say you put that same $7,000 into a traditional taxable brokerage account, but you choose some low-cost, low-turnover index tracking funds like VTSAX or VOO. This time, you do experience a slight tax drag on capital gains and dividend income, so your effective return looks closer to 7.5% as opposed to that 8%. After 35 years, instead of $1.2 million, your portfolio would be worth around $1.08 million. That's a difference of more than $126,000 just from tax drag alone. Now, does that mean that taxable brokerage accounts are bad? Absolutely not. They offer freedom and flexibility and immediate access to your funds, and they are a key part of an early retirement strategy. But this example does show why it's so important to take full advantage of tax-advantaged accounts first, like Roth IRAs, 401ks, or HSAs, because tax-free compounding is incredibly powerful. But here's the cool part. Even with a taxable brokerage account, you could still end up paying zero on your withdrawals if you manage your income carefully. That's because qualified dividends and long-term capital gains are taxed at special lower rates, and in some cases at zero. So if your total taxable income, which includes any ordinary income, long-term capital gains, and qualified dividends, stays under those thresholds, you can withdraw gains from your brokerage account and pay $0 in capital gains tax. For example, a married couple with no other income could potentially realize up to $96,700 in capital gains and dividends completely tax-free. And when you add in the standard deduction, which is $30,000 for married couples in 2025, you could have up to $126,700 in gross income and still pay no federal income taxes on your investments. That's pretty powerful, right? Taxable brokerage accounts are a key part of early retirement planning because they offer flexibility and control and power over how much and when you access your money. You get long-term capital gains treatment, you can manage your income year by year, and with low turnover index funds, that tax drag stays relatively low. That being said, they aren't tax-free, and those withdrawals aren't tax-free unless your income stays well under certain thresholds. So that's why it's still so important to take advantage of retirement accounts, which allow your money to grow completely tax-free or tax-deferred, depending on your situation. So use both together. Stack up your tax-advantaged accounts, your traditional retirement accounts, and build up that brokerage account to give yourself the ultimate flexibility. That way you can have control over your early retirement and access to these tax-deferred or tax-free funds once you get to those more traditional retirement years. Next, we have a Roth IRA conversion ladder. This one isn't just smart, it's strategic, legal, and incredibly powerful for early retirees. Here's how it works. Maybe you stop working early, and when your income takes a dip, this is a great opportunity to convert funds from a traditional account into a Roth. You convert a portion of your traditional 401k or your traditional IRA over to a Roth IRA. You pay income tax on the amount you convert that year. Then, and this is key, you wait 5 years. After that 5-year period, you can withdraw the converted amount tax and penalty free. It's like building a pipeline of future income streams. Maybe at the age of 45, you start doing Roth conversions. By age 50, that first round of conversions becomes available. The following year, the next round of conversions becomes available. Eventually, you've built a rolling series of tax-free withdrawals, all without accessing your retirement funds in a way that triggered any penalties. When you retire early, your income usually drops significantly. This opens up a unique opportunity to convert money from a traditional 401k or a traditional IRA into a Roth IRA, where you can pay a lower tax rate, maybe 0%, maybe 10%. This allows you to move money from the tax later bucket to the tax never bucket. Yes, you may have to pay taxes today, but hopefully you're doing that at a lower rate because you're doing it when your income dips, and it also reduces future RMDs. There are some important considerations to keep in mind. Only the converted amount becomes available once those 5 years pass. The earnings follow a different rule unless you're 59 and a half. Also, each conversion starts its own 5-year clock. Watch out for ACA subsidy losses, higher tax brackets, and Social Security taxation if you're doing large conversions. Also, there are 2 5-year rules you need to know. Number 1, Roth Contributions. This first starts when you open any Roth account. After the age of 59, and as long as the account has been open for 5 years, all contributions and earnings are tax-free. So if you're over 59 and a half and have had any Roth for 5 years, you're in the clear. Rule 2, Roth Conversions. Each conversion has its own 5-year clock. So if you withdraw early and you're younger than 59 and a half and these 5 years have not passed, you will owe a 10% penalty. But once you're 59 and a half, this conversion rule doesn't apply if you've had any Roth open for 5 years. Let's say you retire at 45 and convert $30,000 each year. At 50, your first $30,000 becomes penalty-free. At 51, your second $30,000 becomes available. By 55, you've built a ladder of tax and penalty-free income to last until age 59 and a half. All of this is done without tapping into your funds early and paying any early penalties. In this Roth conversion ladder, it may not be flashy, but it is one of the most effective tools you can use to finance an early retirement. You convert tax-deferred dollars into tax-free income streams today. And if you do this right, when your income is low, it can be a huge tax savings to you and keep your long-term plan on track. The rule of 55. If early retirement puts you on the cusp of retiring in your early 50s, this rule is pure gold. Under IRS guidance, if you leave your job in or after the calendar year you turn 55, you can start taking distributions from your current employer's 401k or 403b without triggering the 10% early withdrawal penalty. There is a public safety exception for this. So for firefighters, police, EMTs, air traffic controllers, they can access their funds as early as the age of 50. That means you don't have to wait until 59 and a half. If you want to retire at 55 from your current employer, you can access this 401k or this 403b completely penalty-free. This is a great way to build a 4 to 9 year bridge, 9 years if you're a public sector employee, where you can fund your retirement penalty-free. You can even get a job working elsewhere and still continue these withdrawals completely penalty-free so long as you don't move them from the employer you retired from. There are some important caveats to note. Number 1, it must stay in the employer's plan. If you roll your 401k over to an IRA or to a new employer's plan, you lose the access under the rule of 55. It only applies to the job you left at 55 or over. You can't access funds in a previous employer's 401k. It has to be the job you are actively contributing to and the one you actively left at this time. 3, you still will pay income taxes. If it's a traditional 401k or 403b, you still owe taxes on these withdrawals. They just don't have a penalty associated with them. So again, if it's a traditional account, you still owe ordinary income taxes. And importantly, plan level rules matter. Not every employer allows for the rule of 55 withdrawals, so make sure to read about your plan or just ask your HR department. Say you retire from your employer at 55, you withdraw annually without penalty, funding your lifestyle while leaving your other retirement accounts, like a Roth IRA or perhaps a taxable brokerage, completely untouched. That delay means longer tax-free growth and strategic tax planning later. The bottom line is the rule of 55 is often an underutilized but very strategic early retirement planning tool. You have to make sure that your plan allows for it, and if it does, you can use this as a smart withdrawal strategy to fund your early retirement as early as the age of 55 for a traditional worker or 50 for a public sector employee. Substantially equal periodic payments, or the rule of 72T. If you are eyeing an early retirement and you want to tap your IRA penalty-free before the age of 59 and a half, this is a powerful tool, but with some serious strings attached. The Rule 72T lets you avoid the 10% early withdrawal penalty by taking equal annual distributions from your IRA or former employer's 401k or 403b for the longer of 5 years or until you turn 59 and a half. You still pay ordinary income tax on the traditional account, but critically, that early withdrawal penalty disappears. Now, how you set it up is you choose one of the 3 IRS-approved methods: the RMD approach, which is based on your life expectancy, fixed amortization, or fixed annuitization. Then you stick to that amount every single year with practically no flexibility. If you do change it, you will retroactively introduce penalties and interest charges. This could serve as a bridge to the age of 59. It's ideal if you're retiring in your late 40s or your early 50s and need a steady income. This allows for really smooth budgeting. You get a predictable set of income every single year, but it is fixed. You cannot skip or increase or stop any of these payments without triggering some very serious penalties. Now, there are some important caveats to keep in mind. These withdrawals must be substantially equal on an annual basis. There's no mixing them up. There's no changing the amounts. The withdrawals must continue for 5 years or until you reach the age of 59 and a half, whichever is longer. If you attempt to modify or stop these distributions, the IRS will penalize all previous distributions plus interest, so just don't make changes. And importantly, not all plans allow for this, so check your plan carefully if it's something you're interested in. Let's say you're 52 years old with $500,000 in a traditional IRA. You set up a substantially equal periodic payment plan using the amortization method, which calculates a fixed withdrawal of $30,000 per year. Once you begin, you're required to take that exact amount every year for at least 7 years, because the IRS rule says that you must continue for the longer of 5 years or until you reach 59 and a half. Since you're 52, that means 7 years of fixed withdrawals. And here's the catch. If you make any changes before the end of that required period, even a small one, the IRS will go back and apply a 10% early withdrawal penalty plus interest on every dollar you've already withdrawn. This is really great for retirees who are retiring before the age of 59 and a half and want a stable, set amount of income every single year. This is not a great approach if you want flexibility, if you may return to work, if you're overly concerned about incurring a penalty, or if you simply prefer tax-free income like from a Roth. The bottom line, substantially equal periodic payments can be a great strategy for accessing your funds early, but it carries a high risk if you don't stick to the plan accordingly. So make sure if you're going to follow this strategy that you have a clear map, and maybe it's worth getting advice from a professional. Finally, Roth IRA contributions, not conversions. Remember that you can always access your original Roth IRA contributions at any time for any reason without any sort of tax or penalty. This does not apply to earnings or growth or any converted amounts, just the amount you've personally contributed. So if you've been funding a Roth account for years, it could very likely be that you have a very sizable pool of cash that you can access without any sort of strings and without having to pay any sort of taxes. So this is a really important consideration for those who want to do an early retirement and leave other accounts intact and untouched. A health savings account, or an HSA, is one of the most powerful and underused tools in early retirement planning. They are really the only account that is triple tax advantage. The money you put into them is done on a pre-tax basis. If you invest it, it gets to grow completely tax-free. And then so long as you take it out for qualified medical expenses, it comes out completely tax-free. And here's the strategy. If you pay for your medical costs out of pocket now, save your receipts, you can let your HSA grow and then reimburse yourself years later, even in retirement. And that means tax-free withdrawals on your own schedule. Plus, once you hit the age of 65, you can take withdrawals from this account for any reason, non-medical related, but if they are non-medical related, then you would have to pay ordinary income taxes. But in this way, it can serve as a backup IRA. That combination of flexibility, tax-free growth, and penalty-free access, especially for medical care, it makes this one of the best accounts for an early retirement and bridging that gap until you get to Medicare at age 65. When you're planning to retire early, it's not just how much you've saved that matters, it's where you've saved it. Different accounts become accessible at different ages, and if you don't know the rules, you could end up paying unnecessary penalties or taxes and run out of the wrong money too soon. Early retirement isn't about pulling from one account and completely draining it. It's about layering your accounts so you can access them at different times and create smooth income streams throughout your entire retirement, no matter what age you are. Let's say you're retiring in your 40s. Taxable brokerage accounts are your first layer, penalty-free, flexible, and tax efficient. In your early 50s, Roth IRA contributions become another layer you can tap anytime. And if needed, SEPP gives you structured IRA access, though it's inflexible and best used with care. At age 55, the rule of 55 kicks in, letting you draw from your current 401k penalty-free, but only if you keep the money with your current plan. By age 56, maybe you had a Roth conversion ladder going and it's starting to pay off, giving you tax-free and penalty-free income if you started converting at the age of 51. And then at 59 and a half, every account becomes accessible. IRAs, 401ks, and Roths, and now the real optimization begins. When you layer your accounts like this, you get control, flexibility, and tax-smart income streams that last all the way into traditional retirement. Early retirement isn't about just saving more, it's about getting strategic with your thinking, having as much access to as many funds as you possibly can. So fund your brokerage, fund your Roth, layer your accounts, make sure you're set no matter what stage of retirement you're in. Thank you so much for being here, and remember that early retirement isn't fancy, it's simply a formula. What age are you planning on retiring? I'd love to hear. Put it in the comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Why is that doggy barking? Is it okay? Taxable brokerage account is bad. I'll take a break. I think my neighbor's playing with his dogs. Withdrawals must, but now there are some important tax law. If without any fines. I don't know what I want to say. There are some important